And in our top business story, growing budget deficit will see GCC countries lever up and risk further credit rating downgrades, according to a new report. The research by credit analysis and convertible bond specialist Fitch Asset Management shows a clear slowdown across GCC money markets, with softening prices resulting from continued macroeconomic uncertainty. Fitch's market trend indicator for pricing from mid-August to late September showed a decline in performance in Abu Dhabi equities, Dubai corporate bonds and equities, Kuwait corporate bonds and equities, and Saudi Arabian equities. The report comes after Saudi Arabia, Oman, and Bahrain have all suffered ratings downgrades since 2015. With oil prices remaining relatively low, Fitch said GCC deficits are expected to grow, with sovereigns and corporates likely to lever up, leading to further rating downgrades. Fitch added that while the pipeline for new issuance for the end of the year is valued at around $50 billion, most global debt investors will continue to take a cautious approach to GCC issuers. Implementation of value-added tax will herald in a completely different outlook on life in the UAE, as preparedness and the right strategies will be key for businesses to manage the impact of the legislation. That's the message from business leaders as they led discussions on the new tax regime. Titled Let's Talk VAT, RSM UAE, the audit and tax advisory firm, hosted a seminar to discuss implications of the new tax regime on businesses in the UAE and consumer spending, which comes into effect in January 2018. Describing it as a stepping stone towards a new and normal economic environment, panelists added that companies will now have to adapt a comprehensive approach towards governing and develop strategies for managing the change, particularly in the financial sector. Despite the impact on consumer spending and added costs for all the businesses, the Associate Director of RSM UK stated that VAT should be considered as a self-assessment tax and should be viewed as a strategic business issue. Among the key areas, including hiring the right personnel to manage the legal elements, as well as implementing preparatory systems to adapt to the new requirements. Among other areas that companies will now have to consider is the pricing strategy and the level of added cost they choose to absorb in order to gain a competitive edge or let the consumers bear the added expense. Furthermore, the officials added that irrecoverable tax VAT will be a major challenge, particularly for the hospitality and real estate sectors of the UAE.
I think the main strategy is talk to your software supplier in terms of the automated elements of your accounting systems. Make sure that they understand the needs of your individual business, particularly where you have a bespoke system written specifically for your business. But understanding that they will introduce the capability to allow you to develop that. But perhaps more importantly, and this will be a time-consuming process, is to train and to recruit appropriate personnel to deal with that at an administrative and a strategic level. And certainly senior finance personnel will need to understand the impact of VAT on individual transactions in terms of creating budgets. Indeed, what they don't want is a VAT directly affecting the profitability of the business.
These essentially are the strategic decisions that businesses will start to think about as to how much percentage of VAT can they actually transfer to the customer without impacting the buying decision too much. Given that it's 5% on a lot of low-value items, it may not be so. Buying a coffee, buying a sandwich, it may not be that significant. But when you go to buy a Rolex watch, you go to buy a car, so high-value items, there's going to be some discussion in those businesses as how much can you actually pass on to the customer. The other major sector, and for the UAE also, is real estate, residential, commercial, construction, because these are really high-ticket value items, as you heard in the presentation as well. So there we still have to wait and see how legislation impacts VAT. So for instance, residential real estate in the UK is exempt of tax, but commercial is not. So then there come in all the hotel apartments, the rentals that you give. Then is there going to be a difference between a long-term rental and a short-term rental? if you provide more services. So these are all questions that we'll have to decide after legislation is out, and considering all the aspects of legislation, whether that product or service falls into a taxable category or a non-taxable category.
In February 2016, the UAE Ministry of Financial Affairs had revealed that VAT is expected to be introduced at a rate of 5% with some limited exceptions, including basic food items, healthcare, and education. While offering the perspective of private firms in the UAE, the managing director of Daman Investments added that the new tax regime will elevate the quality of accounting professionals in the UAE due to the new reporting system. Furthermore, it was added that a majority of UAE companies are on the beginning preparation stage, and there will be at least 1 or 2 years of clarities, as the areas of exemptions have not yet been announced.
This new era is going to be different. I would neither say it's good nor bad. It's just going to be different. There will be positive elements to it. Increased revenue for the government, which means better spending. You are going to have a more organized and structured private sector, because now they have for the first time reporting obligations, etc. On the bad side will be obviously taxation, where before there was no taxation, increase in the cost of some goods and services. So you can't say it's a black era coming, neither is it a completely good era coming, but it's just the realities of a new era working with VAT that everybody has to adjust to. I think you are not going to replace something without VAT, something with VAT for something without VAT. If the regime comes, it's going to be a blanket regime throughout the economy. So it will be similar to a price adjustment. Whereas you were used to working with particular prices, you will be working with a new set of prices. I think life will go on.
All properties being marketed in Dubai, including those developed overseas, will now have to get an online permit via the Real Estate Regulatory Agency's Tarakhisi program. A new circular released by the agency outlines all of the updated requirements for companies to follow in publishing any real estate announcement from inside or outside the country. As per the circular, any announcements not bearing a real estate permit number will now be dismissed as of this month, and the statement added that in the event of non-adherence, all necessary legal procedures shall be taken against the violating companies, and a fine of 50,000 dirhams will be paid by the offenders. According to Ali Abdullah Al-Ali, the director of the Real Estate Licensing Department, the announcement reflects RERA's commitment to protect investors and regulate the market by preventing the emergence of any irregularities. According to local reports, the Land Department is in the process of activating escrow accounts for brokers marketing properties from outside the country, and the Inspection and Control section will work to control real estate advertisements and to ensure that advertisers obtain all required permits. Volumes on the Dubai Gold and Commodities Exchange touched close to 14.76 million contracts, growing 40% from the same period last year. This year, the exchange recorded an average volume of 75,148 contracts a day, valued at around $1.71 billion. The exchange also capped the third quarter with over 5 million contracts, growing 26% from Q3 in 2015. Despite the festival season in September, trading activity significantly gained momentum post-Eid holidays, with DGCX trading an average of 88,131 contracts a day, growing 33% from the same period last year. The exchange also registered the highest average monthly open interest position of 438,111 contracts, representing growth of 172% over the same period last year. During September, the exchange also recorded its highest ever open interest of 593,583 contracts, valued at over $9.1 billion. The standout performer of the month was the Indian rupee, and Indian rupee options contract, which witnessed robust trading activity, registering close to 215,088 contracts this year, up 151% from last year. The options contracts also recorded a substantial year-on-year growth of 707%, trading an average of 1,956 contracts per day.